Okay, let's get this thing going. Uh, I do want to apologize in advance before we do this. In here in South Texas, there's something called cedar, and it's a great tree if you want a nice deck, or maybe you have it in your cabinet somewhere. But it is a real motherfucker when they're all over the place. And every spring there is cedar fever, where these trees dump their pollen and it literally coats the outside world and it royally fucks me up. So I have been sneezing and congested all day. If I mute, it's probably because I'm sneezing. I'm going to attempt to mute if I feel a sneeze coming on because my sneezes are quite aggressive and loud, and I don't want to fucking jump scare anybody. So, with that being said, we're going to get into the second portion of this boot camp. And tonight, the way that this is going to work is we're going to cover change in state of delivery, order blocks, and fair value gaps, right? So this is going to be kind of the second part of you building a model. In our first class, we went over liquidity. If you guys should, but at this point, have a pretty solid understanding of liquidity. Once you kind of get that down, then you can start to look for changes in structures and entry models with like order blocks and fair value gaps. That's why I was really pressing y'all to not get too far ahead of yourselves. You know, last class there was a lot of people kind of asking questions about fair value gaps and things like that. Just be patient. Let's go through this together. This is going to kind of be the second part of that, and then we'll have the third and possibly fourth parts in the next couple of weeks. All right. So tonight, as I kind of mentioned, we are going to look at understanding change in state of delivery and how to identify what model you are in, right? You've probably heard me say before, if you've known me for a while, you've been around for a while, that there's only a buy model or a sell model. There is only a liquidity seeking algorithm that is delivering price, right? There is not a bunch of guys on Wall Street mashing the buy and sell button. Most trading, especially trading coming out of New York, is automated these days. You know, they got better things to do. They got big plastic titted girlfriends and houses in the Hamptons, and they are very rarely sitting in front of a computer pressing buy and sell. Even mid to low level analysts, there's not a lot of hands-on active trading when it comes to hedge funds, banks, market makers. The people who are pressing buttons actively are retail. And there's a reason they call retail dumb money. We want to learn smart money concepts to get on the correct side of market maker level trading, right? So the first thing that we have to do is we have to kind of identify what model the algorithm is in and when it changes. Okay. To build on top of that, we're going to learn about order blocks and how we can utilize them as a trade entry, but also just being able to identify them, right? Once there's a change in state delivery, you have an order block created. We're going to look at that, and we're going to also look at examples on charts for all three concepts that we're covering tonight. Lastly, we are going to look at fair value gaps and different types of fair value gaps, whether that's an inverted fair value gap, balanced price range, etc. All right. Everyone can see the screen and hear me all right, right? Speak now or forever hold your peace. Okay. So, what is a CISD? What is a change in the state of delivery? The change in state of delivery, again, it's important to remember from the first class, and there's a lot of argument surrounding this, right? I think when it comes to ICT traders, you're kind of fully on board or you're kind of right in the middle. mostly on board. I do think that there are some things that throw the algorithmic model out of whack. There are obviously going to be news events like Rob and I have kind of said before, you know, if there's a fucking nuclear bomb drop, that's not going to be coded into the algorithm. There's some sort of black swan event. You know, I'm sure also these banks have an ability to turn algorithmic models on and off or adjust them slightly. But in general, it's important to remember that the markets do not move randomly, right? They are delivered by algorithmic models, okay? And those two models, as we kind of discussed, are a buy model in which price is moving higher to seek buy side liquidity. And again, as a reminder, buy side liquidity is where shorts have their stop losses placed, okay? If you are short a position, you are buying to close your position back, right? You're selling it to open, you're buying it to close. So if you're short over a swing high or a series of relative equal highs, bears have their stops located where they would buy their position back at a loss, hence buy side liquidity, right? So buy model seeks buy side liquidity, sell model seeks sell side liquidity. Now, a change in the state of delivery is when that model shifts. All right. So when price behavior confirms that that model has changed, most importantly, after sweeping a key level, right? Change in state of delivery, when you're looking at them, it's either going to be invalid or not very strong unless a point of interest, a series of relative equal highs or lows, or a major swing point was first swept. It would behoove you in your trading to only start looking for changes in the state of delivery after a liquidity level has swept, right? If you have something that's kind of intraday, there's a good chance you're dealing with chop, right? After a session liquidity level has been swept, or a daily or a 4-hour or a weekly liquidity level, that is when you're going to see the most clear changes in state of delivery, right? So that is very important to remember, that you just don't want to try to mash together where these candles are closing without context. It's important to remember always in trading what your context is, okay? So this matters because it is going to tell you what model the market is currently operating in, right? That'll help you decide what your bias is, okay? And with most traders, when you see counter trend trading or they're on the wrong side of the trade, 9 times out of 10, it's because they were directionally incorrect, meaning their bias was off, right? So if you can start to understand these very simple concepts and just train your eye and spend a lot of times on charts and understand what your liquidity levels are and then where your change in state of delivery is, you're literally like 90% there. Okay? A lot of people who are ICT traders are able to extract a lot of money out of the market with very simple concepts. So once you can start to understand this, you will start to see a change in your profitability. I can almost guarantee you that, right? So it keeps you aligned with price delivery. It helps you, it prevents you from counter trend trading, right? You're not catching knives. You're not trying to short very aggressive pops. Okay. And being on the right side of the direction of the market, as long as you have enough time on your trade, you're going to have a much higher success rate. Okay. It keeps you from fading the direction that the market is moving, because no matter how much you think you can look at a chart and say, this is so oversold, or this is so overbought, or this market's a scam, and you just constantly are battling the order flow, understanding changes is going to greatly affect your overall profitability, right? If you know the active model, you can stop guessing. It gives you a directional clarity, right? And it helps you also improve your trade selection, okay? You're not just randomly lobbing trades out there. You're looking for a very specific signature reflected in the candlesticks that will allow you to initiate an entry model, which we will get into, in other classes. Okay? So, identifying a change in state of delivery. And the way that this is going to work this class tonight, by the way, folks, is I'm going to explain these concepts, right? When we get to the end of the state of delivery, change in state of delivery section, I'm then going to flip it over to Rob, and he is going to show you real chart examples. So don't worry if these explanations feel or seem very abstract. We're going to put 2 and 2 together. All right. Rob and I are going to give you guys a nice Eiffel Tower. So just be patient. We will cover everything. So, how to recognize this shift in delivery, right? And as we kind of discussed, a CISD, or some people just say CSD, right? It's identified through a shift in candle body behavior. All right. You want to focus on the candle body. Do not pay attention to the wicks when you are looking for a change in the state of delivery. As Rob and ICT has said before plenty of times, wicks do the damage, right? In this context, you want to pay attention to the body because that is the story that the market is telling you. Okay. So in the context of a bullish change in the state of delivery in which a sell model flips to a buy model, you need to again remember your context, right? Price has been delivering lower into a sell model. Okay. As that price is delivered lower into a sell model, what you want to look for is a sweep of a liquidity level, right? After a key level has been swept, what you want to look for is a candle that closes above the open of the prior bearish candle or series of bearish candles, right? Like let's say you have a major liquidity level on SPX. Let's just say for shits and giggles, it's 6,800, right? You're on the 15-minute chart. The market's kind of been selling for a good portion of the day. You feel that, I've probably diminished my risk to reward too much to try to stab a short, even though I know my draw on liquidity is 6,800, right? So you're watching the 5 or the 15-minute chart. The candles come down. They sweep that 50 or that 6,800 level, and then they start to print some bullish candles. Let's say there are 3 candles that lead into that point of interest, right? When the next series of bullish candles or a singular bullish candle closes above the open of that bearish candle or the series of bearish candles, and you get a full candle close over it, that is your first change in the state of delivery, right? So it indicates that quote unquote sellers or the sell model is losing control of the delivery, that the draw on liquidity has been met, and it suggests that the algorithm has started to switch into a buy model. It is the opposite with a bearish change in state of delivery, right? Price has been delivering higher in a buy model. It has been sweeping buy side liquidity targets. Whatever your draw on liquidity is for buy side, it has been met. Okay? Once it has been met, you start to see sell candles print on your chart. It doesn't matter if it's one strong bullish candle that goes into your draw liquidity or 5 that go into your draw on liquidity. When that single candle or that series of candles has a bearish candle that closes below the open of that first candle that started that sequence into your draw of liquidity, you now have a bearish change in the state of delivery. Okay? So it suggests, again, that your buy model is flipping to a sell model. And I know that that might be a lot to try to visualize. It's going to make a lot more sense when we look on some actual charts. Here would be an example, just an infographic, right? We're going to look at some real life chart examples of a bearish change in state of delivery, right? Let's say that this is your major all-time high level, right? Or your major buy side level. You have buy candles. We pull back a little bit. We catch a gap here. We pump up and we sweep out this major important level, right? Here is your singular bullish candle that pushes up into your buy side drawn liquidity that you, as a smart trader here in Ironheart, have previously identified, right? Because we're all doing our homework every week. We're reviewing our charts and we're marking out important liquidity levels, right? So it gets tapped. You have two down close candles which close very well below the open of this candle right here. So this series of candles down creates your model flip. This is your change in state of delivery. And as you can see, price comes back up to try to test that change in state of delivery level, and it continues to sell. So again, as we've kind of discussed in plenty of classes and charting sessions and everything else, buy side of the curve, major level, sell side of the curve. Understanding your change in state of delivery is going to help you identify what market model you are in and help you be directionally correct in your trading, which is very important. And like I said, I think most people are fucking their portfolios up because they are on the wrong side of order flow. So understanding this very simple concept will help you be on the right side of that order flow, and it will drastically change your hit percentage. I promise you. So again, between last class and this class, these two classes together, if you put in the fucking work and you put in the time on the charts, you will see a huge difference. Here is an example of a bullish change in the state of delivery, right? Sell model, selling, 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 little retrace, expansion down into this important sell side liquidity level, right? Buy candles. Once this candle closes over the open of this candle, and I know that this is not exactly correct, but I battled ChatGPT for like 6 hours on this fucking infographic, and I finally gave up. But you get the idea, right? This level over the open of this candle, close over, retest that change in state of delivery area, and continue higher. Sell side of the curve. Major liquidity sweep. Buy side of the curve. Simple as that. So, what does a CISD signal, right? What does it mean when that algorithmic model starts to shift? Okay, as we've kind of said, it's an indication that the delivery model has changed, right? Once a major liquidity level has been swept, price is going to start moving to the opposite side of liquidity, right? So if you are in a sell model and you are seeking sell side liquidity, and then there is a major liquidity sweep and there's a change in the state of delivery, it is then going to be seeking buy side liquidity, right? And again, it signals that directional control is weakening or has changed, all right? And it allows you to be early on the reversal, okay? It appears before a clear break in market structure. It provides earlier awareness than traditional trend confirmation. And it allows your positioning to be in place before broader participation recognizes the shift, right? We don't have to wait for fucking the 9 and the 21 EMA to cross. We don't need to wait for RSI to get oversold or overbought. We don't need to worry about MACD or titty squeeze 9,000 custom indicator. Whatever the fuck nonsense you have on your chart, all of it is lagging. These indicators need to calculate mathematically based off of candle prints. Being able to identify changes in the state of delivery allow you to position yourself on a trend shift earlier than general participation in the market. And I see this in my own trading a lot, right? A lot of you guys are probably in owls. There's many times where I alert a swing trade on Tesla or Marvel or whatever the fuck else I'm trading, and I get into a position, and what happens over the next couple of days or weeks? Then you start to see options flow. I waited for a major liquidity level to be swept on Tesla. I got long. Our calls are deep in profit. Then you start to see Tesla call flow hit the tape, right? It allows you to be first or early, which again can greatly help the profitability of your trading, right? It also allows you and helps you to determine your realignment of bias, right? So if you are short and you see a bullish change in the state of delivery, it's time to get out of your short or close your puts, right? It allows you to make the decision to abandon your directional bias. And if you can get past the emotional side of trading, which I think is the hardest part of trading, it allows you to develop a very clear-cut series of steps or signals that would tell you when to abandon your bias, right? Like I said, if you're long or you're short and you see a model shift, you know that you can get out. You can either take the loss or take your profit and get out. And again, it helps you trade. It prevents you from trading against active delivery. What is the delivery model currently in? If it's in a bullish buy model and you are in puts, that'll tell you what to do, or vice versa, right? And it keeps you executing aligned with the model that you're in. Like I've said, you want to stay on the same side as institutional order flow, right? It just improves the probability of successful trades. You know when you can knife catch or when you can short a rocket, right? It gives you a clear signal when it's safe to try to catch a knife and get into calls, or to short a very strong candle up and get into puts. It reduces that exposure to the counter trend trading. All right. It is so important to understand, because I've, like I said, I've been doing this a long time, and I've seen many, many, many traders come and go. I've seen a lot of failure in this line of work, brutal failure, right? And the easiest way to avoid that failure is to be on the same directional side as the algo is delivering in. You could be fucking half retarded. As long as you know where institutional order flow is going, you will have a much higher probability of success. And I know I'm reiterating this over and over, but it's important to understand. Okay? So, once you kind of have an idea of what a change in the state of delivery is, it can help you execute a trading model. So, from the ground up perspective, what you want to do as you always do when you're pulling up a chart and you're looking for a trade, is you want to establish your higher time frame bias, right? What model are you currently in? What is your draw on liquidity? Are you in a buy model? Are you looking for higher prices? Are you in a sell model, looking for lower prices, right? Determine what that draw is. Understand that that change in the state of delivery needs to align with a higher time frame bias, right? So if there is a weekly change on the state of delivery to the downside, you should only be looking for shorts or for puts. Then you want to go down to lower time frames and find a bearish change in the state of delivery. Higher time frame is always going to rule, right? If you are in a weekly or monthly sell model, price is going lower. So it does not matter if you are on the 5-minute chart and there is a 5-minute change in the state of delivery to the upside, because the only thing that that is doing, it is going to allow price to reprice higher so that you can get into shorts for price to go lower, right? So don't worry about bullish change in the state of delivery on like the 5-minute or the 15-minute or even the hourly chart, because you know that the weekly or the monthly is in a sell model. You need to align that CSD or CISD within the context of your higher time frame draw on liquidity and market model. Okay. Then what you want to do is you want to look at your active model, right? If you're in a higher time frame buy model, for example, you want to see price moving higher, right? You want to find your change in state of delivery that confirms that transition, right? And you don't want to anticipate, because the market is fucking tricky like that, right? I've been in trades plenty of times where, I tend to be a reversal trader. It's where I like to position myself, right? Because I think what's extremely important within the context of trading is risk to reward, right? And in my opinion, the highest risk to reward is always a reversal, because you have a very clear defined invalidation level, like under an order block or under a swing point, and you have the most to gain in the opposite direction if your change in the state of delivery is confirmed and the model flips from a sell model to a buy model and starts to seek higher prices. Okay? So I have been in situations before where I have jumped the gun. As you know, with the way I trade, I tend to build into positions. And I think a large part of that weakness in my own trading is not waiting for the confirmation, right? You want to wait for the candle to close. You could be sitting there all day or for multiple days or for weeks. The trade is only going to be safe when that change in state of delivery has a full candle closure over the open of that series of bearish or bullish candles that you are looking for to confirm your change in state of delivery, right? So you want to wait for the confirmation via a candle close, meaning it could be a weekly candle, a 4-hour candle, or a 1-minute candle. That candle, the timer on that candle needs to go to fucking zero, and a new one needs to start before you can confirm it. Once you have confirmation, the model has shifted. Then what you want to look for is your entry model, which we're going to explain a little bit in the next couple of sections, but you want to look for either an order block or a fair value gap. You want to find an entry model, whether it's an inverse gap or a balanced price range or an order block. You want to wait for price to give you an entry in which you can execute. All right. You place your stop just beyond the opposing liquidity level. You take profit on opposing liquidity levels, right? So if you're in a sell model, It sweeps a major liquidity, and then it reverses and it prints a change in state of delivery. You will then be looking for price targets for take profit levels on the buy side of the curve. You mark out your major weekly, 4-hour, hourly buy side liquidity targets over swing points or relative equal highs, and that will be the next area that the algo is targeting. Okay? And that way you are aligned with the active delivery model. Now, are you always going to have 100% hit rate on this? No. Maybe it was an hourly change in the state of delivery, and that was just a reprice for a 4-hour candle to go a little higher before it hits a weekly bearish gap or bullish gap for price to continue. You always need to trade within context of your higher time frames, and you always need to accept the fact that you could be wrong and mark out where your validation level is. If price closes below that invalidation level, you can exit your trade. So the benefit here, like I said, is not only being early, right? You can identify early market trend shifts or continuation. You also can get out under a clear defined level instead of trading emotionally or hoping it's going to come back. As soon as you see that candle close under your invalidation level, accept it and move on. Okay, that was changing the state of delivery. So now what we're going to do, let's see how smoothly we can do this, is I'm going to stop streaming and I'm going to let Rob stream and show some examples of CSDs.
Let's do it. Let me open up TradingView.
We're always prepared here at Ironheart Capital, folks. This is top tier stuff that you're getting for free.
Y'all are good? You see my screen? Yes, no, maybe so? Yes. Yes. Alright, cool. Alright. Daily chart. First example. TT, you just want me to do one, right? For now?
No, you can do a couple, man. Do like as many as you feel drives the point home, and then we can move on.
Okay.
You definitely do more than
Then,
that.
like I told you, I'm going to do a daily, a 4-hour, hourly, 30-minute, and a 15-minute example. Then, because those are all the ones that I have. So, Monday. Oh, this is on ES. So, yeah, right here. We can go in replay mode, start new. So, like he said, important, relevant level, right? If we look on the weekly chart, we were close to this low at the time when we were before this daily candle, right? We have a weekly low and a daily closure very close to each other. So the market's not just going to leave this, it's going to take it, and once this area is met, you have to wait and see what occurs. And so notice how price closes so close to the low. That's another thing to just note. But look at how the next day prints. We take this low, and now we have a bullish candle. This would be a potential reversal. What did TT just explain to you guys? What do we need? We need a closure above the opposing candle that took out the low. Here's the opening price. That's what this blue line annotates. And what does the next day do? We close above here. So with that in mind, and clear buy side targets above, what can you anticipate if this is a Monday closure from a Friday reversal? You can expect what? A continuation higher. What does price do? Continues. Notice how the candle open lows into the opening price. No large retracement. What do you notice? You get that Tuesday, or you get that Wednesday continuation after that Tuesday continuation into the drawn liquidity. This is the daily chart's just going to be the easiest way to see it. But obviously this is hard to actually take a trade on, so that's why we go to the lower time frames. So the next example we will do is a 4-hour chart on NASDAQ. And this was actually pretty recent. This was from December 10th, 2025. So we can leave replay mode. So this is where we had all that SMT on price. Here's these. This is where the SMT occurred. So that helps your context when you're looking for a trade. Actually, this isn't where it was. This is where it was. So right here, this is what I was looking at. We have our objective, which is reached here. You can see we cleared out these highs, and then we close below here. And this is a case where price retraces very deep. Notice the high was never taken. And this is what happens when you're, again, this is why I do not trade the reversal, but TT explained that the reversal is going to give you the highest risk to reward, and you can see why, right? If you catch this move, you have a clear defined stop loss. And so in this case, we have a up close candle that took out these highs, and now we have a bearish closure below that opening price. Price has a very large retracement, not typically what you want to be seeing, but the important thing is if you were in this trade, this would give you some clarity, this second closure here, and then you guys can see how price continuously sells after that occurs. And if we look at ES, you can most likely see, yeah, so you can see here that ES actually ends up taking out that high. So that is why it's also important to short the weaker asset if you're looking to short something. But it's the same concept. It doesn't matter what time frame you're looking at. It's always going to stem from a high, a relevant level that needs to be taken, and then a candle closure needs to be through the opening price of the opposing candle. So if we're looking for a bearish sell model, we're looking for an up close candle to get closed below. And if we're looking for a bullish buy model, we're looking for a down close candle that ran into an important level to get closed above. The next example is going to be from the hourly chart. So let's do that. Where is this? February 4th, 2026. Wednesday. Okay, perfect. So, let's go to replay mode, start new. Okay. If we go to the 4-hour chart, you can see where we're delivering from. We have this 4-hour gap as our important level. Doesn't need to necessarily be a high or low. And so price has a shallow run into this gap. That would be our key level, this gray box. And what do you notice? You have a series of up close candles that gets closed below right here. And a fair value gap. We have that flip from a retracement, now looking for a potential continuation. What do you notice to the left? We have some relative equal lows as a draw on liquidity. If we mark those out, you can see you can short that retest, but they stop at the high, and you can target the draw on liquidity. And the same thing goes for here. If you're not a reversal trader, you can trade the continuation. We get a closure below here, and price continues lower. It's going to be this same thing every single time that you're looking for it. Relevant level, if we go back to the 4-hour, we can just use this line so it's not an actual gap. Highs are taken, and then getting closed below there. That's your reversal. That is your bearish change in the state of delivery. And notice, if I go back out to the daily chart, you can see that we are trading aligned with the higher time frame order flow, right? This is that Wednesday candle after that Tuesday displacement day. So that is why you could be looking at this 4-hour for value gap for price to continue out of it. That's what I mean by aligning your time frames, right? That's what TT talks about, having that higher time frame narrative. Context, that's what you need every time before you put on a trade. 30-minute example, January 21st, 2026. Okay, so if we go out to the daily chart, you can see price is sweeping out previous daily low. This is what that higher time frame context is important. If we go to the 30-minute and we play price, what does the day do? During the London session, price is opening lower into that potential area where you could see a reversal from. Now what does price do after this is taken? A shallow run below this low, and now you have this series of down close candles, and it's getting closed above here. The opening price is getting closed above here. Now what does the next candle do? Opens lower into our order block or change in the state of delivery. Notice how price was selling into the low, consolidated, and then gave us that quote unquote light bulb, right? This is that where you can see, okay, wait, is price now going to flip into a buy model? How do you know? Well, the next candle opens lows and goes higher. And so you have a draw here, which is a very short-term draw, but you have more importantly this high up here, which is previous day's high. If we play price, you can see exactly what happens. And that this exact candle is why you take profit at a logical level, which is something I preach all the time. Again, the same thing, it's just going to look a little different the lower time frame you go. And the last example is going to be on a 15-minute chart. January 16th. So this is something that, this is a pretty beautiful trade. This is, if we go back out to our hourly chart, this is our relevant high. This is not a previous daily high or anything like that, but this is an hourly swing, and this is, again, this is something that you can do the lower the time frame you go. It doesn't have to necessarily be based off of the daily chart, but in this case, this trade is being, or the day is being reversed off of an hourly high. Look at the 15-minute candle. And I always talk about 9:30. If you guys are new, I want to be seeing 9:30 potentially set a higher low or a continuation. In this case, 9:30 is reversing into what? This is our hourly high. This is the high of day so far. So if price fails to get through this, where is price going to go? It's going to go lower to the sell side liquidity below, right? What do you notice? Price takes out high of day, reverses. How do you know this is a reversal? Well, you have the series of up close candles that is running out the high of day, the current high of day, and now you are closing below that last or that first opposing candle of the series. That opening price here is getting closed below, and then now you guys can see what happens next. Right? A clear knife after price failed to break out above this high. Again, how do you know that this is a failed breakout? the change in the state of delivery confirms that this is a protected high to then trade away from. Every time frame is going to look the exact same. It should. Your trade should look the exact same every single time. That's all I got, TT.
Alrighty. I will start streaming again if you want to close yours, and we'll get into order blocks. Okay, so we've kind of talked about change in state of delivery, right? And so now we're going to look at kind of the other side of that coin, which is order blocks. You guys like, yeah? You paying attention now? All right. So order blocks. What are order blocks? They are candles, a single candle or a series of candles that forms after a sweep of liquidity and ideally with displacement, right? The order block is from the, as Rob just said, from the opening price of the single candle or the series of candles that moves into a key area of liquidity. Those candles or candle becomes your order block, right? It is a place where there's an accumulation of positions by the algorithm, right? And there is displacement ideally in that area, which is going to indicate the start of your change in state of delivery. And that series of candles represents the order block, which you can use to you can really use them as a trade entry, right? So ideally, it must occur an important higher time frame level, right? Like Rob just went through, showed you a bunch of examples of how a buy model or a sell model met a higher time frame area of liquidity and then created displacement with a close over a series or single opposing candle to create your order block, right? So a bearish order block, you would see a sweep of buy side liquidity, you would see displacement lower, and then you would see a close below the open price of that single candle or series of up close candles, right? It can be either or. A bullish order block would be a sweep of sell side liquidity, displacement higher, and then a close above the single candle or series of candles that were the down close candles into that higher time frame or key area liquidity, right? And the final close, either up or down before that displacement, is what creates your order block. So here is a bearish order block, right? So buy model comes and sweeps your buy side liquidity. Here's the single expansion candle into that important level. Then there's a series of down close candles. When this candle closes below the opening price, again, the body, the opening price of this candle then becomes your order block. And as you can see, it comes back in to test that order block and it rejects and continues the sell model, which is why you can use order blocks as entries. And in my opinion, I think Rob would agree with me, they tend to work a lot better than fair value gaps. So if you were to take it short based off this, you have a very clear protected high because you had this change in state of delivery. So if this is a true CSD, you know that the model has stopped seeking buy side liquidity levels and is now seeking sell side liquidity levels. So you know that this buy side level is safe for you to put a stop. Put your stop here, you enter on a retest of this order block, you take profit at key levels of opposing liquidity. Same idea with a bullish order block. You are in a sell model. You sweep an important level, whether that is an hourly or 4-hour or daily or weekly level, depending on the type of trader you are, right? If you're a scalper, if you're day trading, I'm not expecting you to sit there and wait for a weekly level to be swept, although I would highly recommend you trade only off of higher time frame liquidity levels, but you can take reversals that are within reprices of higher time frame models, right? So it comes down to this important level, expands lower, comes back up, expands higher, closes over the opening price of this down close candle. This down close candle now becomes your order block, retests that order block, continues higher. Sell side of the curve, buy side of the curve. So again, it's very important to know your context, right? That's what Rob tries to preach. That's what I try to preach. That's what we try to tell y'all here in this server is always important to trade within context, right? A valid order block should always have clear displacement. It should have a break in opposing side momentum. It should have liquidity taken before it is formed. And it should have good solid expansion away from that level. Okay, it is not really valid if it forms mid-range, if it's a 1 minute change in the state of delivery and you're on a fucking monthly sell model. Probably not the most valid order block to be trading off of. You always need to understand the context of where you are in the larger picture, right? If you don't have any good displacement, that also reduces the probability, right? I think we've talked about plenty of times in charting sessions where, you know, you have a change in the state of delivery level that you're kind of watching, where I say, you know, this candle just kind of barely closed over the CSD level, but it's not really the strongest. You don't see that displacement, right? It's always better to wait for the displacement, to let the price show you what it's going to do, right? Don't anticipate. So if you have a clear level that you're watching, whether a singular candle that has swept liquidity or a series of candles that has swept liquidity, and then you are watching the opening price of that single candle or series of candles, and price comes back up and it just kind of barely closes over it, or it chops around and consolidates over it, that does not create a very strong order block. Like the example that Rob just showed you, after ES or NQ swept that major daily level, what was the thing it did as soon as it got a CSD? You had good expansion into opposing side liquidity. That's the sort of trade you want to position yourself on, right? There are times when you have a liquidity level that is swept, right? Let's say next week you studied the class, you're looking at charts, you're not immediately expending money and participating in the market because this is a new concept. So you're paper trading, you're watching price play out. A level is swept, you get some consolidation, there's some kind of lesser move back up, like let's say it was a sell model, and it swept a major sell side liquidity level, and you're looking for a reversal to get into the buy model, right? Major liquidity level is swept, price comes up, it kind of chops around, it maybe closes over that opening price, that series of candles or single candle that took liquidity, but it really was not convincing. That's the sort of trade you don't want to get involved in, because maybe price is accumulating to continue lower on higher time frames, right? It doesn't always happen black and white. So the best way, in my experience, and that what I've seen, is you want to wait for expansion, right? You can sit there and pattern trade all day long and say, oh, well, you know, this price closed above that price, so why isn't that a valid order block? You always want to keep context in the back of your mind when you're trading. So another good thing that you can do is you can use a fib tool to find your mean threshold, right? And this is going to apply to both fair value gaps and order blocks. So all you have to do is on your fib tool, take everything off it and just check one box and type in 0.5, 50%. The halfway point of that candle or that range is your 50% mark or your mean threshold, right? Right at equilibrium. So if you draw a fib on the 50% of your order block that you have identified from body high to body low, again, only the body, right? That 50% mark, that mean threshold should be respected, okay? If the order block is a valid, strong order block, price will respect that 50% level. And this is especially important to do when it's a series of candles that sweeps liquidity, right? Because if you're trading like futures or SPX or something like that, I mean, 15-minute candles can be on something like NQ. If you have 2 or 3 of those running into a major level, that could be a pretty wide amount of points, right? So if you draw a 50% fib on those series of up close candles before a bearish change in the state of delivery, for example, that 50% mark should be respected. And it can also kind of help you tighten up your risk, because if price doesn't immediately reject or respect that 50% mark, or it starts to close over it, there's a good chance that the order block is not strong or it's not valid and it's going to get ran through, right? Now, if you're very disciplined and you wait only to take the 50% marks of those order blocks as a trade entry, the only trade-off is you will miss fills. I mean, that's a part of trading, happens every day. You want to train yourself to wait for your entry model, make sure all of your boxes are checked, wait for an order block to be retested, make sure the 50% mean threshold is being respected and it's not getting closed over. Wait for price to come to you, right? If you miss the fill, you miss the fill. That's part of life. The market provides endless opportunities every day. Do not get into the habit of abandoning your rules and chasing entry, because it's a good way to get stopped out. So again, most important, drawing a 0.5 fib on an order block helps you visualize where you should start to look for a good trade entry. That doesn't mean you can't enter as soon as it's retested. It doesn't matter. It doesn't mean that you have to even wait for it to be retested. You could trade continuation. You could trade out of a fair value gap. But that 50% mark is going to give you an idea of kind of where the best entry is going to be. So in continuation, after that reversal, you can look for continuation order blocks at previous order blocks, at fair value gaps, and around liquidity sweeps, right? So for example, in a bullish continuation, you have your down close candle or series of down close candles into that important level. You have your close above that single candle or series of candles. You wait for that price to retest that order block and give you entry, right? And then you would target opposing side liquidity after the model flip, right? If you're in a sell model, major liquidity sweep, you get your bullish change in the state of delivery, it comes back to test that order block, you have a clearly defined stop loss at that protected low, you target buy side liquidity. With a bearish continuation, it's the opposite. You have a single up close candle or a series of up close candles into that important liquidity level. You have ideally solid displacement in the opposite direction. A close below the opening price of that single candle or series of candles, a retest of that order block, and then a target of sell side liquidity, right? Sounds like a lot, but again, when you start to look at it on charts, it makes very clear sense, and it allows you to develop trading parameters which will protect your profitability and your capital. Right? Like Rob just said, your trades should look the same every day. I know that there seems to be a culture in trading today where everyone's, big ego and flipping out and, pinging 100 times and everything else. But trading should honestly almost be boring. You should go in every day, minimize your emotions as best you can, understand what your trade parameters are, and stick to those trade parameters. That's it. So the great thing about ICT is it gives you a few tools that you can develop into your own trading model, and you can be very, very consistent. And consistency is what allows you to survive in trading. So once you enter, as Rob showed you, right, you will see a confirmation of a change in the state of delivery. You will see an order block formation, and the high or low below or above that order block will become a protected swing point, right? A protected high or a protected low, where it is easy for you to place your stop loss, right? So you can place your stop over or under that swing point at the opposite end of the order block, right? And that's why, in my opinion, I tend to like reversal trading, because as soon as you see a good change in the state of delivery, personally, what I do is I wait for like a weekly or a daily level to be swept, and then I wait for a 4-hour change in the state of delivery. And that allows me to keep my risk very tight under the 4-hour low. And I have a lot of room on the opposite side opposing liquidity, because I'm on the 4-hour chart. So I'm expecting a series of 4-hour expansion candles, which can lead up to quite a few points or a good percentage movement on the asset class, right? So it allows you to identify where your invalidation level is very early. And it allows you to get out of a trade when you are wrong relatively quickly, instead of waiting for some other signal that you're leaning on, whether it be let me ping this guy to see if he's still in this trade, or the EMAs haven't flipped, or RSI is still oversold, so I know it's got to turn around at some point. Once you identify where your order block is, if the price closes below that order block again, you can get out. You know where your stop is. If you're trading futures, you're going to just get tagged out. But if you're trading options, you know when to exit your trade. All right. I will now give it over to Rob to let him look at some order blocks and show y'all some examples.
What's it called? Let me reshare my screen. Well, the thing is this is an order block is a change in the state of delivery, if you guys didn't get that. So all the quote unquote difference is, there's not even a difference, but it's just literally when you can start to see that price is now going from a buy program to a sell program. So I feel like the lower time frame stuff would be more helpful for most people, because we're not taking trades off of like a 4-hour chart for the most part. So if we just we can look at this most recent example that was based off of the daily chart, because that's normally where I get a lot of my stuff from. This is a perfect day. We can do this. And I like to use the hourly for the most part. We can mark out this high. And this is important because it's the previous day high. And if you notice, we have the previous day high here. And even the hourly chart is going to be too high of a time frame for me when I'm trading the New York session. So what I typically look for if I'm trying to frame a reversal is that I like to use the 30-minute chart. And then if for an actual entry, I'd like to use the 3 to the 15-minute. And ideally, it's either going to be the 3 or the 5. So when the day opened, price just ran out previous daily high. And you can notice that nothing really significant happened until when? Right? Now we're just sort of consolidating a slow grind up. And now we have this candle closure through on this opposing candle. And if you notice, what time does this occur, right? London session. You typically want to be trading away from a London high or low, ideally, because that gives New York a lot of room to expand, which you can see this occurs. And so going into the New York session, which was over here, you can see that price doesn't really do anything other than retest this up close candle. And if we're looking at this from a continuation, you can either use this candle or you can wait for this candle. Just depends on your style. And going to the 5-minute, we can sort of see what price does. 9:30 occurs after that second closure, opens highs, retests, and then goes lower. If we look at the 3-minute, this is typically where I like to get my entry from. You could technically take this. I would never, but you could technically take that. This is what I would have taken if I'm looking for a continuation entry, which would have been here shortly after 9:30. Huge closure. You can wait, get in on a lower time frame. Just depends on your trading style. But getting on this closure or using the 5-minute all depends on your style of trading. That's why I try to say to you guys, and if you look at the 5-minute, you can see this gives you much better risk to reward. If you're going to take this closure with a stop here and take profit at a 2R, you can see it gives you that relatively easily. When you're trading New York session, I highly recommend the lower time frame for order blocks. Another example we could use would be over here. Same sort of context, right? And this would be same sort of thing. We're looking for these relative equal lows down here. What do you notice? You have price taking out previous daily high. We can go to the lower time frame after we have our relevant level marked out. I typically like to see the 4-hour and the hourly. If we play price, you can sort of see what's going on. Now we're heading into the London session and New York. We can play price, and so this is sort of what I'm looking for, right? Same exact thing. I typically, when I'm looking for a reversal to trade away from, I like to use the 30-minute because that gives you a little more room, so you don't have to wait as long, and the same sort of thing occurs, right? This was that previous daily high over here. Price takes that out, fails to reverse, right? If you notice, do you see this is that potential change in the state of delivery, right? And you can see you would have been stopped out. That occurs, and that is also the risk of trading a reversal. In this case, and also there's two things to note. Notice the size of this opposing candle, and notice that price is in a consolidation. Those are things to keep in mind. I'm not going to get too much into that, but notice the difference here, right? And I think not all of you are new, and I do teach expansion met with expansion. Now, which one looks more promising, right? Does this look like price is expanding after putting in a relevant high? No, right? Does this look like expansion met with expansion? Yes, right? Look at the V-shaped top. Is there a V-shaped top here? No. This is like a slope, right? So those are all things to keep in mind. And look at the candle body size as well. And also this would be during New York session, which is typically where I look to trade anyhow. So this is overnight. Typically don't like to see that. Again, takes out the high, closes below, then you could go into the lower time frame to get your entry. And if you're looking for that 5-minute change in the state of delivery, you can see you get that closure below. If you get a 3-minute, probably could get in even earlier. Yeah, so same thing here. You actually get the retest on the 3-minute, and price is expanding a lot lower. It's the same exact thing as what we just went over and all the other examples for this change in the state of the delivery. I don't want to bore you guys to death. It looks the exact same just on the way up. I could try to find one bullish example just off the top of my head. That'd be easy to spot. Always start on the daily chart, which I like to do. And yeah, so this would be a pretty good example. This is from last year after all that Trump news. It's like one of the largest days percent gains in history or whatever. So if we look, this would be our failure swings here. These are that sort of range low. This is too far away. I don't need that to be ran out. And so once we have this reversal here on the daily, we can see that we have this down close candle that ran out the low. We have a closure above that opening price. And if we go now into the next days, we can be looking for a higher time frame draw, which is this up here. And like I said, I like to go to the 30-minute. It's typically where I like to, alright. Typically where I like to look for my entries or my reversal candles from. And so this is a perfect example of that, right? We have our low, and what do you notice? Our down close candles, they get closed above here. You could be longing inside of this fair value gap typically, or you could just be longing the high, right? The wick is a part of the series of down close candles, and then price is expanding. What do you notice when price flips, right? It was in a sell program all the way into this potential area. Now price is closing above, and the change in the state of delivery is flipping from a sell program to a buy program. You have another opposing candle that gets closed above here after tapping into that fair value gap, closes above. Again, same thing. Notice, again, this is just something to touch on and be cognizant about. Look at these two small candles, right? I always stress candle body size because there are higher probability order blocks than others. This is something you guys can keep in mind. Am I going to long these two down close candles after we get a closure above? Personally, I am not. Now look what happens. The low gets broken. Now we have a larger, thicker body candle that gets closed above. And what do you notice? Price never breaks that low. That's just something to keep in mind. And what do you have? Price continues into our drawn liquidity many, many days later, that entire week, based off of that reversal candle. And typically, if I'm trading away from something like this and I'm expecting a higher time frame move, I will use the hourly chart or the 4-hour chart to confirm that this is most likely a protected low. So in this case, the same thing happens. This would be our last down close candle. This entire series here gets closed above. That could be also a higher time frame entry for you guys to like swing options or whatever. Or, like I personally do, you can trade the continuation, which would be either based off of this closure, or in this case, if you want to just go off of based on what I said, you can wait for a thicker down close candle, but you guys can see it kind of just gapped up and left you. That's going to happen. This isn't obviously a end all be all thing. You're not going to never take a loss. That's not how this works. Sometimes you're going to lose. That's trading. There's nothing that works 100% of the time.
All right, nice job, Roberto. Let's get back into the rest of it. So the last section is going to be on fair value gaps, just kind of another part of creating a trading model, understanding price action. So here we go. You guys are going to pay attention to this slide, I think. What is a fair value gap, right? Fair value gaps are price inefficiencies, right? It is a 3-candle pattern, right? It occurs when the first candle's low does not overlap the third candle's high, or the first candle's high does not overlap the third candle's low. All right. It represents an imbalance in price delivery, right? It comes with an aggressive expansion or displacement in one direction. It doesn't have a two-sided trade, meaning that there are unfilled orders within that fair value gap, right? So there's probably been plenty of times where you expected price to move higher or lower. You tried to get into a trade, but price moved before you could get in, right? You missed your fill. Well, in the context of retail trading, most of us who are not trading ICT or trading EMAs or whatever, it's too bad, so sad you missed your fill, right? Or people chase, and then when price comes back to test and fill those unfilled, non two-sided trades, they get stopped out because they chase the displacement instead of waiting for the retest, right? So smart money is greedy. They are going to see expansion or deliver expansion of price, and they are going to have unfilled orders within that price imbalance, and they will oftentimes have price come back to retest that imbalance so that those orders are filled and then price continues. So a fair value gap has very specific parameters, right? There is no overlap between the first candle low and the third candle high in a bullish context, right? There is no overlap in the first candle high and the third candle low in a bearish context. And the candle in the middle is a clear and valid displacement candle, right? It's good expansion. Strong move up or down after the open, very small wick candle, right? If it's if you have expansion, but there's wicks that touch on the third or on the first and the third candle, that is not a valid fair value gap. That is the most critical part of identifying a fair value gap, is that the wicks of the first and third candle do not touch, right? Just like in our Eiffel Tower example, you do not want wicks touching, right? There's nothing gay about an Eiffel Tower as long as there's expansion in the middle of them. So here, and again, I apologize if my screen looks like red. I have a blue light filter on my computer. But here is the wicks of these candles, right? This is the low of the first candle and the high of the third candle. There is a clear displacement candle in the middle, and the gap between these wicks represents your fair value gap, right? These wicks are not touching, as it should always be. This is a valid bearish fair value gap. On the other side of that coin, here is a bullish example, right? Here's the high of the first candle, and this should say low, but ChatGPT is retarded, so just imagine this says low. Here's the low of the third candle. There is no touching of these two wicks. There is only an expansion candle in the middle, right? This is a valid bullish fair value gap. And these candles can be as large or as small as you want them to be, or as they reflect on the chart. But the most critical part is that the wicks cannot touch, and there has to be an expansion candle in the middle. So different types of fair value gap, right? You have buy side, sell side imbalance, and sell side imbalance, buy side imbalance, right? The busy or the SIBI, okay? A SIBI is just a bearish fair value gap, right? The sell side was not delivered. It is buy side inefficient and price was displaced lower. On a busy is a bullish fair value gap. Buy side was delivered, but the sell side is inefficient and price displaced higher. Okay. All that is understanding what directional context you are looking at in your trade, right? If you are on a sell side of a curve, you have a valid change in the state of delivery with an order block created, as we've already discussed, and then you get into a buy model. You only want to be marking out buy side imbalance, sell side inefficiencies, right? You only want to be marking out the bullish fair value gaps because if you are in a true model flip, the opposite fair value gap will likely get ran through. They can often create a place where there is some quote unquote resistance or price slows down and consolidates in that area. But if you are in a true buy model, bearish fair value gaps will get inverted and vice versa. So, same thing from that first example, right? Candle 1, 2, 3, wick low of this candle, wick high of this candle. Here is your sell side imbalance, buy side inefficiency, or bearish fair value gap. The opposite side of that coin, here's the high wick of your first candle, the low wick of your third candle, and here is your bullish fair value gap created by an expansion candle in the middle. Fair value gaps always have 3 candles. You cannot create a fair value gap with 2 candles or 1 candle or 5 candles. It has to be within 3 candle systems. The consequent encroachment of a fair value gap, which is just another fancy way of saying the middle line or the mean threshold, like we talked about in order blocks. Fair value gaps also have a mean threshold, which is the 50% of that gap, right? From the start of that gap to the full gap fill, you have your 50% mark, right? And the nice thing about TradingView, which most people are using these days, you don't even have to draw a fib. You can go into your rectangle tool option, you can click on midline, and it will automatically print the consequent encroachment of whatever gap you are drawing, okay? So, just like the level, the mean threshold of an order block, you want that 50% of that fair value gap in general to be respected. It's going to be a stronger continuation or reversal model if the 50% of that gap is respected. Taps the CE, closes back out, right? If you see price coming up, you got a sell model, major level sweep, change in the state of delivery with good expansion, like Rob just talked about, with the creation of an order block and a fair value gap. You want to see price come back in. Test is a very good sign if you're starting to position yourself bullish. That price come down, tests that CE and wicks back up and closes back above the gap. 9 out of 10 times, the next candle is expansion and continuation, right? Now, if price starts to close beyond the CE or it flips the gap entirely, that gap is no longer valid, and often it's an inverse fair value gap, and that could also be a reversal signature. Damn, I put all these titties in this class, and we're having people drop like flies, man. Okay, so last thing we're going to talk about before Rob shows a couple examples of fair value gaps is an inversion gap and a balanced price range. Okay, so a fair value gap inversion is when a fair value gap is created and then price comes back to that fair value gap and closes through it. right? The consequent encroachment is violated. The imbalance is no longer respected. Some people will often use that as trade confirmation of either continuation or reversal. Like I know Swami and Bev use those a lot. I have started using them less. More often, I use order blocks, but an inverted gap is another good sign of a reversal, right? If there's a major shift in model after a liquidity level is swept and there's an old fair value gap, like let's say there's displacement into a major sell side level, right? And that gap is inverted on the way back up, that's a good confirmation to say, okay, I've had my major liquidity level swept. I had my change in state of delivery, which created my order block. And on top of that, we inverted this bearish fair value gap. I'm probably pretty good to get long. Okay. A BPR is the same idea, except it's when a bullish fair value gap overlaps within a bearish fair value gap, right? You have expansion met with expansion. You have in within those three candle systems, you have a bearish fair value gap that's created or a bullish fair value gap that's created. Price trades back into that gap and then expands directly back through it. Okay. It is a good sign, again, if you are looking for continuation or confirmation that the model you are in is confirmed, right? You want to see these sorts of PD arrays invalidated or violated if you are looking for a shift in model. Okay, I'm gonna give it a Rob to show a couple examples. I do have an assignment in here. Like I said in past classes that I've done, you are not required to do this. You have to ask yourself how badly you want to be a profitable trader, right? You are not going to get good at this if you don't put in the work on the charts. These are questions. I'm not going to read through all of them, but they are questions that will make you go to your charts and find examples in real life of everything that we just covered. So if you go through these and you mark them out on charts and you drop them in chat, everybody can look at it. We can give you feedback and it'll help you start to internalize the concepts that we are teaching you now. All right. Again, not required, highly recommended. And with that, I'm going to give it to Rob, let him show you a couple of fair value gaps. And then when he is done, that is it for the night.
Alright, these are the easiest thing to see just because, like TT said, a valid fair value gap is just going to have a gap in between a gap in between the three candles. So this would be a valid look at a fair value gap, right? Right here we have this candle, we have this large down close candle, and then we have this candle. Notice how there is a gap in between the candle 1's low and the candle 3's high. And so with everything that we're looking for, right? And we have a sweep. Now, if you guys want to combine everything, right, from a higher time frame perspective, and we have a potential open draw down here from a daily perspective, you can see how Wednesday takes out Tuesday's high, and then Thursday is an expansion day, and it's closing beneath this opposing candle. Now we have a fair value gap in between that, and this is exactly where you could find a potential continuation entry to the lows below. This is a valid fair value gap because of the spacing between the candle 1's low and candle 3's high. Now this is something that a lot of people, when they're new, don't understand, and this is a example of a invalid fair value gap on the daily. This would be candle number 1, this would be candle number 2, this would be candle number 3. A lot of people will just see this wick and say that this is somehow a fair value gap. A fair value gap has to have spacing in between candle 1, and candle 3. See how there's nothing open? All of this is like colored in, shaded in, however you want to make it make sense in your brain. There's nothing open here. This is a fair value gap. This would be candle number 1, candle number 2, candle number 3. See how there's a space between candle number 1's high and candle number 3's low? That is an inefficiency, meaning price has not came into this area yet. This is open. Just notice what price does next. Opens, comes into the bullish fair value gap, and then the trend continues higher. To look at it from a 4-hour perspective is the exact same thing. You'll just see them more frequently. And the smaller the fair value gap, normally the lower probability it is. So in this case, notice again, there's not really too much of a decisive price run yet, and this fair value gap gets totally blown through. Notice finally, once we get a clear one-sided price run on this way down, what do you notice? The 4-hour fair value gap is supporting price lower. This would be candle number 1. This is candle number 2. This is candle number 3. There's a space between candle number 1's low and candle number 3's high. And my fair value gap here is just a rectangle 2 on TradingView, already has the 50% marked out. That's that consummate encroachment, or changing this, or not changing the state of delivery, the CE, right? And this is what TT was talking about. I'm using my fib tool. I can mark out from the low to the high. This would be that 50% area, and you can see price hits that and then continues lower. From an hourly perspective, it's going to be the exact same. Nothing changes from time frame to time frame. And again, the smaller the fair value gap, the less likely it is to work. Notice how these are here, not something you typically want to see, especially when the price has already been exhausted, right? These are all things you have to keep in mind. But if we're using this fair value gap here, price is dipping into that, hits that 50% of that again, and then goes higher. Same thing here. This would be candle number 1, candle number 2, candle number 3. Notice the spacing in between here. There's nothing, this area hasn't been colored in yet, right? Until this candle does what? Opens into this fair value gap. Okay, no more of that. We'll show you some BPRs, or inversion fair value gaps. And so this is that same example from earlier, but this would be, this is your important low, right? That was ran out. Now we have a bearish fair value gap. Why is this a bearish fair value gap? Well, you have candle number 1, candle number 2, candle number 3. There's spacing there. That would be your fair value gap. Notice how price immediately closes above the 50%. That is typically not what you want to be seeing when you're in an expansion phase of price and when you're looking for continuation lower. Sometimes, of course, that's going to happen. Again, I want to stress this enough. This is not a black and white thing. This is not a 100% hit rate strategy. If somebody is telling you that, they are lying to you. This price closes above this hourly fair value gap here. That could be your potential indication that now this is a protected swing low. Now pair that with an order block. So now you have a relevant area taken out. This is this black line. Now you have an inversion fair value gap here. Now you have an hourly change in the state of delivery. This down closed candles that took out the low is now getting closed above. And then guess what? Now you're getting that continuation flip. Notice what I just said to you guys prior. I said when you're in an expansion phase of price, you do not want to see deep retracements. What does price do? Barely comes into that hourly fair value gap and explodes higher. Same thing. Price runs out a short-term low and a retracement. Bearish, a quote-unquote bearish fair value gap gets blasted through. Why is this failing to hold? Because it is not in a sell program. When you're in a buy program, bearish PD arrays should just be speed bumps, not a place where you're going to get a reversal from. The only time you should be looking to get out of your trades is when a relevant level is hit. Price inverts this fair value gap and goes higher. When an inversion fair value gap is created, this could be a this is now turned into a balanced price range. That's what BPR stands for. Price has already done whatever it needs to do inside of this and no longer has to come back into here. Can it? Of course. Does it have to? No. I can show you guys one more example for the bearish side of things for a just using the hourly chart. The hourly chart is just the easiest. In my opinion, it's like the easiest way to see everything. Just because you'll find a lot of PD arrays on them. There's more frequency of them. So if we go up here, this is a decent example, even though this is a lot of consolidation. Notice again, fair value gaps are going to start to show you when price is in a hurry to leave. And this is something to note. Do you guys see any well spacing between candles here on the downside? This is the only gap in this hourly leg. This is something that I would be avoiding trading, right? Same thing here. There's a gap here that never gets retested. There's a gap here that has a large retracement. Notice how there's not a large one-sided dominant price run. Consolidation with the lower leg down. Consolidation with the lower leg down. And finally, we had some displacement the lower. This is not something that I would trade. That's something that I would avoid. Same thing here. A lot of consolidation. Typically want to be avoiding that. This is something that I would want you guys to be looking at. We can just look at this from an hourly perspective. We're just going to use the most local high just for the sake of an easy example. We run out this high. We have an hourly change of the state of delivery. What do you notice? We have that expansion met with expansion, right? Immediate reversal at a potential relevant area. That's what we're looking for. What do you notice next? A large displacement candle. Creating what? A fair value gap. Now you can expect this to hold price lower if you're going to be onside. And if you notice, you have a very nice drawn liquidity down here. And even if you don't need to target that, you can target this, right? Something shorter term. This price action should hold. And this is something to note. What I just said to you guys earlier. Even though price is creating this bullish fair value gap here, what do you notice? Price is using it at once for support, goes higher, and then closes below here. Now this would be your BPR. And again, bullish PD arrays and a sell model should not support price. And you can see in this case, and in most cases, you also want them to start acting as resistance. This would be your balanced price range. This once bearish or this once bullish fair value gap fails, it gets closed below here, and now is being used as resistance and goes lower. Notice how this is being used as resistance and price doesn't even have to get into this smaller fair value gap up here. That's something to note as well, something to keep in mind. And you have a large displacement leg lower. Everything is going to work if you are on side with the drawn liquidity and if you are trading with the higher time frame order flow. That's what I like to stress. If you're able to align multiple time frames in one direction and then you get your entry model with a fair value gap or a order block, that's when you're going to have your highest probability trades.
All right, folks, that is all we got for class 2. The next session will be taught by Alex. I will let him decide when we host that. And then we will have a final class on AMD/Power of 3, which I will teach. So one thing I noticed tonight, we started off with about 60 people. There's 33 left. I understand that this is almost 2 hours. It's fucking Sunday night. Most people got work in the morning. I get that. Still, you have to put in the work, right? I think all of us here at Ironheart really do try to preach that, and we practice what we preach. We spend a lot of time on charts. We spend a lot of time studying. Rob has an almost encyclopedic knowledge of ICT stuff. He's put in the work, right? So I have a lot of respect for you guys sitting here and grinding through to the end of this class. So I highly suggest you do the homework. No one is coming to save you. You have to do it yourself, right? So we will see you tomorrow. I appreciate you all coming out and spending 2 hours with us on Sunday night. You all have a good night.
Good night, guys. It is recorded for anybody wondering. I have it. I'll be uploaded to YouTube, and then I'll throw it in the my alert channel, and in I'll put it in the my alert channel, in the trading room, and in announcements, so you guys cannot miss it. Good night, guys. It was a pleasure.